Well, there's a new CEO, Adam.
Okay.
So, and we're an intimate crowd. So you're very happy in the corners, the edges, but if you would like to join us, wherever you feel comfortable, no peer pressure. Hi, everyone. Welcome. I'm so glad you've joined us here today. We are thrilled to be here in New York on the land of the Lenape people, who are the traditional stewards of this land. My name's Dara Parker. I'm Tonic's new CEO, which is why I get to poke fun at Tonic's former CEO. We're doing things on time now, Adam. And I am joined by colleagues. Yeah, this is confusing with so many places to look. Nope. Nope. It needs to be up here.
Yeah, you got to get this. It's funky.
Yeah, there we go. No, it shifts. So, yeah. This is fun. I hope we're live streaming already. Oh, good, good, good. Hi, everyone at home. We practiced this and it worked perfectly smoothly before y'all joined us, so maybe it's your fault. Yeah, that's going to be tricky. So maybe we'll do this. Okay, this was just a chance to introduce you all up on stage. So I was saying that I've got three wonderful colleagues here today. One of them is Adam Bendel, who's the former CEO and current president. Melody and tech support. You may be CTO, just stay tuned. Melody Jensen and John Berger is in the corner here. They've all been the leads on the exciting work that we're sharing today. And of course, I've simply shown up to take the credit, which is what I'm best at. But before we jump in, I thought maybe I would force a little participatory action in the audience. So I'm actually going to ask you to turn to someone you don't know and introduce yourself and share what the biggest question you bring today about impact investing is. And we're just going to take 2 minutes to do that. I don't know. I'm just going here now because all right, folks, we'll give you 30 seconds to wrap up those conversations. Okay, I see LinkedIn scanning happening. I see business card exchanges. This is excellent work, everyone. Thank you. Thank you for playing along. If I'd been really on top of it, I would have gone straight into that while we were tech troubleshooting, but everything is going according to plan. I hope you met someone new, sparked some good discussion. And now, as we get started, I'm going to encourage you to use your phones one last time to grab the report, which you can see on the big screen that has just come out today. You can capture that on the QR code or using the bit.ly, and that will download a digital copy. This is, of course, Cruising Altitude, which is the latest report in our 10-year longitudinal T100 project study. And it's the first one that studied more than 100 distinct impact investing portfolios. And then I'm going to invite you to be phone-free for the next 45 minutes so you can really dig into all the exciting insights. I'm going to try and help us arrive in this moment, and I wanted to start by acknowledging the time that we find ourselves in today. I know you've got a lot of things competing for your attention, and I know you also don't need me to tell you that we're in a polycrisis, that there's global unrest, growing inequality, an accelerating climate crisis, a lack of trust in our institutions, a lack of trust in the wealthy. It's a lot. And the last few months have felt particularly chaotic, a lot of whiplash headlines, especially if you're a Canadian like myself. It is a strange time to be in. And we know that many of these problems are complex and interconnected. We also know there aren't any silver bullets, that it takes all of us working in complementary ways to address what we call wicked or systemic issues. And one of the systems that binds all of these challenges together is our global financial system. And I assume that a common thread between those of us here today is the potential we see for investing to play a substantial role in addressing the polycrisis. And yet, with growing momentum towards impact and systemic investing, new complications arise. And I live in the tension that the landscape actually feels more crowded as we reach over 1.5 trillion in assets invested towards impact, but that simultaneously that's not nearly enough to address the root of these issues. We wrestle with content around greenwashing and a rising backlash, which leads at best to questions about impact investing and at worst, deliberate misrepresentations of what it is and what it's not. In our report, we refer to these reactions as turbulence, as part of our metaphorical flight of impact investing. And today you'll find evidence in our report of both increasing market maturity, for which cruising altitude is a metaphor, while we continue to experience some turbulence. There was a lot of turbulence on my flight yesterday as well, and I thought that was taking the metaphor a little too far as I arrived in New York, but here we are. The timing of this launch is a little bit awkward. Most investors, including impact investors, are pretty transfixed by the whiplash of public markets over the past weeks, which makes it hard to shift our attention toward a 10-year study of investing behavior. But despite the turbulence, we know that impact investors are long-term investors. And so I'm going to invite you today to put your intention on those long-term trends and not the daily trading. And perhaps together we can consider this time as a brief respite from the short-term storm. We're really working with this metaphor. It's going to go for the whole 45 minutes. And gathering with those who hold fast to a more positive future for humanity and for the planet, and to learn from the private investors at the forefront of this movement for the past decade. I'm going to quickly refresh you on who Toniic is and why we're up here. We are a global community of private asset owners seeking to steward wealth and use influence to enable a thriving world. We've got many of our members joining us here today and online as we're streaming live. Our members are active impact investors and philanthropists who make up a vibrant community that's engaged in education, investment opportunities, collaborative projects, and events. And we also invest in the field of impact investing, leading by example to move not just money, but also mindsets. So the report we're unveiling today is one example of our field building work. Our Toniic members come from across the world, over 25 countries. We're principally in the Americas and Europe. And the participants in the T100 study, who you'll learn more about in a little bit, are drawn from those memberships. They are high net wealth individuals, family offices, and charitable foundations from across the globe. Melody, who you're going to hear from in a second, who has managed our T100 project, is going to unpack the demographics of our study participants. But I want to highlight a couple of things. That the participants in this study are not your average investor. To begin, they are relatively wealthy, ranging from millionaires to billionaires. So we don't claim what is presented in this report is currently accessible to even the mass affluent, let alone the retail investor. And secondly, they are asset owners, not intermediaries investing other people's money. So this gives them the freedom to invest as they see fit, in many cases without the need to worry about things like fiduciary duty. And even those who have wealth advisors, and most do, are involved in the investment selection to an unusual degree. They're investing in alignment with their own values and typically don't need to gain consensus on those values beyond their family. Thirdly, the T100 participants are a subset of Toniic members who are among the most engaged and thoughtful impact investors on the planet. They invest for impact across every asset class and typically in multiple jurisdictions, which is all to underscore that our findings should not be understood as representing a statistically significant subset. That's a tongue twister we can all play later. Statistically significant subset of the broad investing population, because they don't. Instead, they represent what is possible for wealthy private asset owners to accomplish with impact investing. And as you're about to see, that is extraordinary. And I'm going to pass it to my colleague, Melody, to keep us going.
Thank you, Dara, and hello, everyone. I'm Melody Jensen. As Dara mentioned, I'm the manager of the T100 project, and this has been my world for a little while, so I'm very excited to share this with you and let you into my world a little bit. I wanted to tell you a bit about the project itself first before we get into the findings that we've discovered in the data. So the T100 project has been collecting data for about 10 years. And back when we started, there was an almost complete lack of quantitative and qualitative data points, case studies, stories about active impact investors, much less getting deep into their portfolios. Even people that wanted to get started with impact investing really had little idea how. I like to joke that it was the Wild West out there. And they needed both evidence and inspiration, and the T100 project was our answer to that need. Over the past 10 years, we've invited members of the Toniic community to participate in a longitudinal study of their progress towards full deployment. So that's seeking net positive social or environmental impact in every asset class. Private investors tend to be very private about their investments and wealth, so this data is hard to collect. We've been able to do so based on the trust that the Toniic members have placed in us to aggregate and anonymize their data, using their names and attributing quotes only when they've given permission and they're willing to be named. We feel incredibly privileged to have earned this trust and to be able to share their aggregated data with you. And although the data is aggregated, it's important to note that the primary unit of analysis in the study is a single portfolio. Some participants may have contributed multiple portfolios, so maybe with their personal portfolio and the family office's portfolio, for example. And then others have contributed only one portfolio, and that may or may not represent their entire investable wealth. So we've got a little bit of a mixed bag, but lots that gave data, and we appreciate them so much. And so this process of data collection and analysis and distribution, all of this allows us to provide the evidence and the inspiration for a wide pool of impact investors. We started with 42 portfolios the first time we collected data, and then we got up to 76 for the second, and we finally reached more than 100. This is a huge milestone for us, and not only because our name is T100. It feels like a completion in some ways. But let's get into exactly who contributed these portfolios. So first of all, they're Toniic members. As Dara mentioned, they are high net wealth individuals, charitable foundations, part of a family office, and not representative of the broader impact investing universe, but really among the most committed impact investors globally. Most of them are those HNIs, charitable foundations, family offices, and then a remainder of them are reporting donor-advised funds, endowments, or in a few cases, various special purpose funds or vehicles managed by Toniic members. Portfolios range in size from around 1 million USD to around 300 million. And as you can see, the greatest number of portfolios is in the range of 10 to 30 million dollars. In our aggregated data, we made the choice to weight each portfolio equally so that the big portfolios don't overweight or swamp out the smaller portfolios. And this way you can also draw conclusions about kind of what the typical portfolio allocations of the study look like from that aggregated data. A little bit about the process of the data collection. We built a cloud-based impact portfolio management and data collection platform that we call Tracer. It provides value to contributors by letting them visualize their portfolio along lines that are relevant to them, not just financial pieces, but also enterprise and investor contribution, which SDGs are targeted, liquidity parameters, geographical allocation, etc. And we'll get into a lot of those details in this presentation. It's all that quantitative and descriptive investment data that contributors entered that we can then aggregate, anonymize, combine with different surveys and interviews that we did for really a comprehensive picture on the way that these investors are approaching their impact investing. I want to mention too that we did this together with an academic research consortium led by the Center for Sustainable Private Wealth at the University of Zurich. And that included other researchers from around the world looking into impact investing. All of this work and the quantitative and qualitative data has fueled a number of reports over the years. Our first one was in 2016. And that includes the newest one, Cruising Altitude, which brings us all together today. And with that, let's invite up to the stage Adam Bendel to walk us through some of the most interesting bits of analysis from the new report.
Don't go too far. You're supposed to help me. Okay. So, hello, everybody. I'm Adam Bendel. I now serve as Toniic's president, as Dara said, and chief technology slide whisperer. Let's see. Oh, yeah, thanks. Nope, not moving.
I feel better that we're both failing at this.
Oh, okay. All right, that's good. Me too. I want you to feel better. So I'm going to walk us through some of the key findings with Melody's help. And at the end of this walkthrough, we'll have time for questions. I warn you, actually, that we're going to go through a lot pretty quickly, and we're going to be changing topics because this was quite a broad study. So if you want to make notes of your questions along the way, do that because we'll have plenty of time, and we're really looking forward to the interaction. To bring these findings to life, we are going to introduce a fictional yet archetypal T100 participant named Petra Sanchez as an example. So here are a few quick facts about Petra. Her clicker doesn't work.
We're pausing for dramatic effect. We're so excited.
Guys, can you help us here?
Is the sound okay?
Okay,
here we go. All right, so a few quick facts about Petra. She lives in Madrid, Spain with her small family. She sold the company now I got nothing.
No,
We need more drama and impact.
Yes.
You guys know that the slides
Chris,
are gone. Oh yeah, now the
save
whole
us.
thing's gone. Petra Sanchez. I'm going to just vamp here.
We're good. Okay.
Wait a second. Let's get back to.
Ta-da! Thank you guys for your patience as we work this out. Okay, as I said, she lives in Madrid, Spain with her small family. Thank you, tech support. You guys are awesome. She sold the company that she founded about 10 years ago and was initially allocated in public equities, bonds, cash, but grew discontent with the impact of that and decided to seek deeper contribution. She's passionate about regenerative agriculture because her previous business was in the food industry and she saw the environmental degradation of our food system. And she has an overall moderate growth asset allocation. So she's trying to plan for children's education expenses, but also wants extra to recycle earnings for impact. So she seeks that market adjusted returns at the portfolio level, but she will occasionally target catalytic, sometimes known as subcommercial, in order to get that deeper impact that she thinks is very important. So she is presented today as this personification of maybe the median impact investor in the study. She's just an example, not necessarily perfection.
So let's dive into our first finding, that investors like Petra are increasingly seeking contribution. Let's explore what that means and how T100 investors are applying it to their investing strategy. So in our research, we have aligned closely with the Impact Management Project, the IMP, which is now stewarded by Impact Frontiers. Social and environmental impact under IMP norms can be disaggregated between enterprise impact and investor contribution. We will focus first on enterprise impact. So that is the potential net positive social or environmental impact created by a company in which we invest. The IMP framework summarizes the net impact of an enterprise into one of four categories. In the gray on the chart are those enterprises that do or may cause harm, including companies that don't bother to assess their impact in the world. So they just get, if we don't know, then we assume that they may be causing harm. In yellow are those that avoid harm or seek to avoid harm. In the teal color are those that benefit stakeholders. And those that contribute to solutions are in a color I can't name very well, so I think I'll call it eggplant. As you can see, 55% of portfolios in this data set are allocated to enterprises that were categorized by their investors as contribute to solutions, which represents the deepest form of enterprise contribution. And conversely, only 10% are in the gray does or may cause harm category. So we can see that among the T100 demographic of committed impact investors or private impact investors, it's very much possible to get almost completely out of bad companies over time and into some very good ones. This IMP framework is what we and others in the field use most commonly to assess the depth of impact contributed by a particular enterprise in which we invest.
Our friend Petra uses this framework as an informal, helpful way to map her 10-year journey. I mentioned she originally sold her company, she got cash and invested traditionally at first and ramped up her philanthropy, but began realizing that some of the best opportunities she saw were investments and not grants. And she had so much more available to invest than to grant each year. So she started thinking about how to use her investment portfolio to achieve the social and environmental impact that she targets. I guess she's current tense.
Yeah. So, oh, this is you still, yeah.
Yes. Okay. In the beginning, she was focused on the do no harm principle. She saw negative externalities imposed on society and the planet from her traditional investment allocation, and she didn't like it. So she screened out first the worst companies, concentrated on moving to the best ones, And finally, increased her private investing to focus on those that are actively contributing to solutions, trying to focus on those that are contributing to the shift from organic to regenerative food production for her focus. The ABC framework gives her a way to assess her progress over time. She's been in this game for about 10 years, and she's finally reached the point where her portfolio is more than half contribute to solutions. She has a few legacy investments that do or may cause harm, but not a lot, and she plans to sell those when she can. And she feels like she's making progress in this time.
So Petra's story is common for the T100 demographic. Since the start of the T100 project, we've seen a significant increase in the investments labeled as contribute to solutions, again in my favorite color eggplant on this chart, and a reduction in half of investments labeled as does or may cause harm in gray. So next we'll turn to the other half of the contribution story, which is investor contribution.
So early in her journey, Petra focused on enterprise impact and sought values alignment. So she was really investing only in companies that operated in ways she thought sustainable for people and the planet. But companies that operate this way typically will do so whether or not she invests in them. And over time, she wanted to focus her investments on where her capital had additionality, or in the language of the IMP, specific investor contribution. Put another way, where her investment could cause something to happen that otherwise would not. And then over the 10 years she's been doing this, she's learned to use the full spectrum of investor contribution in her portfolio.
So the pursuit of investor contribution is distinctive to impact investors. According to the IMP, investor contribution takes 4 different forms that distinguish it from traditional investments. Now remember that traditional is legacy for these investors, and it's shown here on the left in purple as representing only 16% of the average allocation. The lightest form of investor contribution is signaling that impact matters, which totals 29% of investments in the typical portfolio. Deeper forms of investor contribution require some additional mechanism to signaling, and there are 3 of those. The first is engaging actively to make a company better. So for Petra, this could range from voting proxies in publicly listed equities that she owns, to conducting an activist shareholder campaign to get a company to adopt regenerative agriculture practices, to helping a private company to become more regenerative by leveraging her expertise and her networks. The next is growing new or undersupplied capital markets. That's like when Petra invests in a company that otherwise struggles to raise capital. Even if that investment she expects a risk-adjusted return, it qualifies as grow. And the deepest form of investor contribution is when an investor accepts subcommercial, flexible, or concessionary returns to achieve impact that otherwise would not be possible. That's a category the field now refers to as catalytic capital. These categories are not mutually exclusive. A single investment might be a combination of these. All of these deeper forms of investor contribution in the various shades of light to dark pink on the chart add up to 55% of the average allocation in the portfolio. So to summarize, both in the enterprise impact and the investor contribution dimensions, leading impact investors are increasingly seeking contribution. Our second key finding is that the pursuit of impact affects asset allocation.
And this is true for Petra. She hasn't changed her desire for moderate growth portfolio overall. Again, she has kids to send to school, is living off the income, etc. But her pursuit of impact has changed her strategic asset allocation over time. She shifted quite a bit from public to private markets, up to now a 33% allocation to private equity. Her fixed income includes private loans to farmers, transitioning to organic agriculture. I'll talk more about that in a minute. And her real assets allocation also has a heavy dose of private direct investments.
Petra is representative of investors in this data set. So this chart represents the average portfolio allocation of investors in T100. A reminder, as Melody said, that our methodology is to weight all portfolios equally, regardless of AUM, which gives us greater representativeness of what a typical portfolio looks like. So the tilt towards equities, commonly observed among traditional investors with moderate growth targets, for example, the classic 60% equities, 40% fixed income allocation, is mimicked here, as you see, with a 63% allocation in total to equities. But look at the split between public equity in orange, 29% of the typical portfolio, and private equity in red, which is 33%. The portfolios of HNI, family office, and foundation investors deeply committed to impact are more heavily weighted towards private equity than their traditional counterparts, who will typically allocate between 10 and 15% to private equity. This difference is due to the desire for enterprise impact and investor contribution. These impact investors are leaning towards asset classes that enable more contribution. Now, a room full of impact investors, we love to debate whether there is a trade-off between impact and financial returns. But another potential trade-off has gotten a lot less attention, and that's the relationship between impact and liquidity. While there are some impactful companies that deliver market rate returns, the trade-off with liquidity is unambiguous in this data set. More impact requires longer lockups of capital. We see this in both the enterprise impact and the investor contribution dimension, though it's clearer in the enterprise dimension, so we'll focus on that. And this chart is a bit complex, so let me walk you through it. The colors you have seen before. Gray is does or may cause harm, yellow is avoid harm, teal is benefit stakeholders, and eggplant is contribute to solutions. The rows represent time to liquidity. So the bottom row represents the greatest liquidity and the top row the least. More specifically, the bottom row are investments promising liquidity within 30 days, the second row within 90 days, the third row within a year, the fourth within 5 years, and the top row is greater than 5 years. So liquidity decreases with each higher row. Now look at the top two rows. Look at how much of that capital is contribute to solutions, more than 75%. And now compare that to the bottom row of investments with liquidity of less than 30 days. Less than 20% contribute to solutions, and more than 60% does or may cause harm, or merely avoids harm. That's a dramatic difference that reveals that on the enterprise impact dimension, the pursuit of deeper impact is associated with longer capital lockups. Liquidity and enterprise impact show an inverse relationship. And the same is true for investor contribution. Now, in some ways, this is obvious. Few would expect that you would have much positive social or environmental impact as a day trader, but this is the first time we know of a data set that backs up that intuition. It also suggests that investors in this demographic are patient. Deeper impact takes patience, and T100 investors appear undeterred by the longer time horizons to achieve their desired impact contribution. On the other hand, this finding can also be seen as pointing to unmet needs in investing products for committed impact investors. This demographic desires impactful investments in every asset class and at every liquidity duration, but struggles to find this impact potential in more liquid investments. It's particularly difficult to find strong impact in cash and similarly highly liquid impact asset classes. And this suggests unmet latent demand for such investment products if they can be created in ways that they maintain their authenticity of impact.
I teased Petra's loans to farmers earlier. As you may know, you can't convert a field that has grown conventional crops just overnight. The soil has been ruined by and become dependent on nitrogen-rich synthetic fertilizers. And to convert such acreage to organic or even better regenerative methods, it's a multi-year process. But most farmers, even larger farmers, lack capital for the transition. They can't begin selling certified organic crops until the transition's complete. And so there's this awkward intermediate time where the costs are being borne, but the profits from it lie in the future. And these farmers need loans to bridge the transition. Petra's willing to make such loans. And this obviously reduces the liquidity of that portion of her portfolio, as she won't see the capital return to her for about 10 more years. But that's fine for her. The investments in other asset classes provide the liquidity that she needs. She's confident that she's achieving investor contribution, as she is causing something to happen that might not. This transition from traditional to organic farming in a country in which she lives.
So to review, liquidity and impact show an inverse relationship, and the pursuit of impact affects the asset allocation of leading impact investors. Our third key finding, depth of impact varies by asset class.
So let's look at some of the investments that Petra has in different asset classes and the way that she targets her impact, specifically regenerative agriculture. In fixed income, I mentioned that she makes loans transitioning to farmers transitioning to organic in Spain. She's also LP in a fund that provides loans for similar purposes to smallholder farmers in Latin America. In private equity, she made a direct investment in an ag tech company that has an innovative soil solution. In private real assets, she's in a real estate investment trust, sometimes called a REIT, focused on farmland used for regenerative agriculture. And in alternatives, she invested in a sustainable commodities fund, working to improve organic commodities market access for smallholder farmers.
Petra's experience is typical. The type and degree of impact investors in this study anticipate having varies a lot by asset class. So each row in this chart is an asset class, and the stacked bar charts to the right show the percent of each asset class in each enterprise contribution category. The impact leader is private equity, in which a whopping 79% of the investments are categorized as contribute to solutions. The next highest impact class is fixed income, which includes private credit, with 43% contribute to solutions. Now, compare that with cash on the top row. Only 3% of cash is contribute to solutions, and 59% of it is categorized as does or may cause harm. Clearly, we as a field have work to do in the cash asset class. So, depth of impact varies by asset class, and we believe that this influences the skew amongst these investors towards private equity in their portfolios. Our fourth key finding is that these investors, even with strong impact intentions, invest more in their home region.
Petra, I mentioned, was born in Spain, lives in Spain. She loves Spain. She knows that there are big problems in poorer parts of the world, and she devotes some of her capital to these regions. But her greatest passion is to transform the local food system. So to achieve that, she's deployed half of her assets into Spain. 35% of her portfolio consists of investments in other markets, particularly euro-denominated investments in the EU, reducing her currency and political risk. And the remaining 15% is in emerging markets.
Again, Petra is representative of the current investing behavior of this demographic. So in this chart, in the teal color is representing investments that target their impact in the geographical region of the investor. The gray, dark gray, represents investments in a global mix, such as funds with a global mandate. And the light gray on the far right represents investments with impact that target another specific region that's not the investor's domicile. So rows represent the domicile of the investor. In other words, this chart compares where investors live with where they seek impact, where they invest. And what do we observe? Investors in most geographies have a strong home domicile bias. For example, 51% of the investments from the US and Canada target impact in their home region. 41% of investments from Western Europe target impact in their home region. Now, this would be completely unsurprising if these were traditional investors, most of whom also invest disproportionately in their home countries. But it appears that some of the most advanced impact investors in the world also have a strong home region overweight. The exceptions are the regions of Latin America and Asia, where globally focused investments predominate rather than those in their home region. This may reflect fewer perceived opportunities to invest in the specific impact themes of interest in those regions, or possibly desire for greater geographic or currency diversification. There was long a perception of impact investing as consisting of investors in the developing world investors in the developed world investing in the developing world. Perhaps that perception has already waned, but certainly in this data set of impact investing leaders, it's not accurate. Now, we're neither celebrating nor condemning this outcome, we're merely observing it and flagging it for further study. Like traditional investors, perhaps these investors seek to limit foreign market exchange and political risk, both of which are heightened in the developing world. Perhaps they're embracing the practice of place-based investing, investing particularly in one's home region. Investing outside of your home domicile, particularly in private markets and in cultures that you don't understand, is complicated and it might create unintended consequences. So there's more work to be done in understanding capital flows between global north and global south, both with respect to motivation and with respect to impact. So to recap, even leading impact investors have a home region overweight in their asset allocation. And finally, our fifth key finding. The impact investing market has filled out, but gaps remain.
Back to our friend Petra. It's been helpful for her to consider her investment themes from the perspective of the UN Sustainable Development Goals, or SDGs. She's also put her portfolio into the Tracer platform, which helped her see which SDGs her investments target. So remember her passion for sustainable and regenerative food systems, and that aligns with SDG 2, Zero Hunger, SDG 12, Responsible Consumption and Production, and SDG 15, Life on Land. And because the climate crisis threatens all food systems, many of her investments align as well with SDG 13, Climate Action.
So it took a while, but the SDGs are now ubiquitous as a lingua franca of thematic impact investing. And that, or maybe thematic impact more broadly, not just investing. And that represents itself a maturation of the field. We integrated the SDGs early in the project, and that's enabled us to observe how the market is filled out from an SDG perspective over the past 10 years. We now see investments in our data set across all 17 SDGs, although not evenly distributed. In the latest data set, the biggest focus of investors has become combating climate change, represented by SDG 13, Climate Action, and SDG 7, Affordable and Clean Energy. And this represents a significant shift towards these SDGs from the last time that we did a study, from our last report. And The focus aligns with reporting from UNCTAD, the UN's Conference on Trade and Development, that estimates the largest SDG investment gap to be for climate solutions and clean energy at around $2 trillion US. Now, we know that this group of impact investors alone can't close this gap, but the data reveals progress towards that goal. Unfortunately, the second largest investment gap identified by UNCTAD was in clean water and sanitation, SDG 6, which is the second lowest SDG in this data set in terms of allocation overall. And this shows an opportunity for investors to lean in and product providers to create new investment products for investors interested in growing new and undersupplied capital markets. But the home region overweight we spoke about earlier and the challenging economics of this SDG do make this an uphill battle. Now let's look at another question about the state of the market that we get all the time. Is it possible to target a commercial rate of return across all SDGs? So first of all, it's hard to answer this question in absolute terms, in large part because our colleague John Berger is always reminding me that commercial rate of return is a vague and variable standard. But if we look at this table, you will see the average long-term expected financial returns by asset class as reported by investors most recently in this study. You will not be surprised by these expected rates of return. They're similar to expected returns in the period for non-impact investments. So cash is 2%, fixed income 5.5%, public equities 8%, and the returns are higher in more illiquid asset classes as you would expect. So this roughly demonstrates that investors who target adjusted commercial rates of return can do so while aligning their capital with the SDGs. While there are still some gaps in some asset classes, for example, it's difficult to find anti-poverty investments in public equities, the impact investing market has filled out significantly in the past decade. But there's another question, which is to what degree do leading impact investors deploying their own personal and philanthropic capital insist on commercial returns? That question can be answered at two levels, at the portfolio level and at the individual investment level. So let's look first at the portfolio level. 36% of portfolios in this study are accepting some level of sub-commercial returns for the portfolio as a whole, the three slices of pie on the left. Now that may surprise you until I remind you what Melody introduced, which is this is a heterogeneous group of portfolios. It includes some philanthropic portfolios that are not providing for the investor's lifestyle. For example, the portfolios of donor-advised funds and those of private foundations, of families who are active impact investors and do not need to argue with a board of trustees about what fiduciary duty does or does not permit. Now let's look at the investment level. Interestingly, many of the portfolios that target commercial returns deploy some catalytic capital to achieve deeper impact. In total, 64% of the portfolios in the study contain some catalytic capital, even though only 36% accept catalytic returns at the portfolio level. This is no doubt a distinctive feature of this investing demographic. It highlights the flexibility with which private asset owners committed to positive net impact feel empowered to color it outside the box of traditional financial constraints in portfolio construction. On average, roughly 19% of the assets in each portfolio in this demographic or in this sample are allocated to catalytic capital. So these investors are motivated to achieve impact that otherwise would not be possible. That shows that both market rate and catalytic approaches and everything in between are more feasible than ever. We see lots of examples across the return continuum in the data set. This may mean that the old debate about a necessary impact versus financial return trade-off is now obsolete because different investors have different return expectations. Some target catalytic returns at the portfolio level. Some include some catalytic investments in portfolios that have commercial return expectations, and some exclude catalytic altogether. The data suggests that all three groups of impact investors are able to find products that meet their return expectations from a filled-out market.
Petra is in the group that targets commercial returns overall, but is willing to lower her return expectations or take higher risk for about 10% of her portfolio so that she can invest in companies that can deliver transformative impact that wouldn't happen if it weren't for her investment. Although this is a relatively small allocation of her overall portfolio, these are some of the most exciting investments that she makes. She stays close to the impact of these investments, and she knows with confidence that she is personally making an investor contribution to deeper impact than would otherwise occur.
So our most recent data demonstrates that the impact investing market has filled out with investment options across SDGs and across the spectrum of capital, but the gaps remain in certain asset classes and SDGs. So those are the findings we are going to highlight today.
First off, we want to thank Petra for accompanying us on this journey, even though she isn't real. Thanks, Petra. We also want to remind you of what Petra does and doesn't represent. Petra is an archetype that you might consider the median amongst contributors to T100. Her portfolio and approach is representative of the portfolio of many portfolios, but of course not all contributors. None of these real investors would claim that they've reached the end of their flight. We're going to extend the metaphor more, Dara. They're perfectly happy with all of their investments. This is a journey of continuous improvement.
So to recap what we found, looking back over the last decade of this study, in both the enterprise impact and the investor contribution dimensions, leading impact investors are increasingly seeking contribution, and they see that as distinguishing impact investing from the broader sustainable investing universe. The pursuit of impact affects the asset allocation of leading impact investors, and liquidity and impact are inversely related. The type and the depth of impact varies by asset class. Even leading impact investors have a home region overweight in their asset allocation, with a typical allocation to emerging markets of 10 to 15%. And the impact investing market has filled out with investments available for every SDG, but gaps remain in certain asset classes. Among leading private wealth impact investors, catalytic capital deployment is more widespread than ever. Of course, it is impossible to cover the insights of a long study in a short presentation. So there are many findings in the cruising altitude report that we haven't covered today. Those include investor willingness to pay for impact, how asset allocations vary by different investor types in the studies, HNI, family office, foundations, along with comparisons to traditional counterparts of those types, how impact is pursued distinctly in each asset class, example investments in each asset class, or at least for most SDGs we have example investments, return expectations for each asset class in each SDG, and some longitudinal observations, what we see has changed over the course of this study. And of course, more depth on the findings that we did present today. Before turning to questions, I want to take a moment for us all to express gratitude to the supporters and especially the contributors to this study. You know, it's trite to say we couldn't do it without you. They always say that, but you can see now, having walked through this data, how literally true that is in this case. Like, we would not have this data if we did not have the trust of our members to share it with us, to aggregate and anonymize. And so we really do thank you all for your dedication, for sharing what you're learning, really at the frontier of impact and systemic investing. Are there any contributors in the audience that want to add anything? Anybody who contributed to the data set that wants to stand up and speak. We
No
remember-
pressure. Remember, they're anonymous unless they
Yeah.
choose to identify
Right,
themselves.
we're keen on that point. Okay, so time for questions. Like I promised, we covered quite a bit. I see a few already. Let me just spur your memory in case something occurred to you and you've already forgotten it, because that would be me. So questions about enterprise impact or investor contribution, about how the pursuit of impact affects asset allocation or the depth of impact by asset class, about the home region focus and the allocations to SDGs, return expectations, catalytic capital, about our demographics or methodology or anything else. So do we have someone that can pass some?
I'm holding it. Let's do
All
it.
right. I'm not going to be the only one to answer. John and Melody can help. But go for it. Yeah. What's the question?
Well, thank you. Thanks very much. Happy to be here.
And introduce yourself if you're willing.
Sure, it's Peter Klein. I'm a Chief Investment Officer of Align Wealth. I'm also President of the Claire Freelander Family Foundation. So I wear two hats, both as an investor as well as a philanthropist person. Petra. She's very smart. Let's face it. She grew a business. She sold a business. She's investing impactfully in that sector. I get it. I worry, though, about the due diligence. This is squishy stuff she's investing in. You can't read up on it. There's no definitive accounting statements. This is difficult. So the first thing I worry about is who's her soundboard? Who helps her? Who should she go back and forth with on the due diligence process? And then the second thing I sort of worry a little bit about, because I'm thinking about it from my perspective, is the patience that's required for these types of investments, right? Because she has kids, she's at college, she's got cash flow needs, she's got to spend money, inflation. So what happens if it's 6 years in and things aren't going the way she thought? And what does she do then? And how could that then be anti-catalytic? Almost like reverse. Just some thoughts. Thank you.
Great. All right. Let me take those in turn, Peter. Great questions or comments. The first one seems a little bit like a setup for like join Toniic, but that is in a way the answer to this question. What we find is that one of the big motivations of investors to join networks like ours and like some of the other, our sister networks that I see represented in the audience, is that kind of loneliness of doing this on your own, the sense that it's squishy, the sense that impact investing is traditional investing plus the impact side. It's not traditional investing minus anything. It's not like, yeah, crappy investing plus I care about causes. Done well, it's rigorous traditional investing plus concern about the impact that you're trying to achieve. And that is definitely raising the bar, right? It makes it harder, not easier to do. And so having peers and colleagues that you can bounce ideas off of is really, really important. And I'm sure, although there weren't any who wanted to raise their hand as contributors, there are many Toniic members in the audience, and they will tell you how that happens, how we do that, how we facilitate group due diligence, find out what people are interested in, and then, sometimes like there's one that we're working on now that I'm personally looking at where where a family office anchor investor has agreed to share their diligence with the Toniic community in advance of making a decision. So I think community is one of the most important antidotes to the complexity that impact investing adds. And then also the second thing I would add is just learning to be a better investor, learning the rigor of this work, which requires, as I say, both traditional impact investing chops and understanding impact well, or one will make mistakes. And I think the third piece is to acknowledge that one will make mistakes, and we will learn as we go, both individually and as a collective. The second question was about patience, right? And what if things don't work out as she hopes? Come on, that could never happen. All right, yes, that does happen in impact investing. Also happens in traditional investing. I just want to note, like those who are only invested in public markets at the moment may have noticed something happened over the last few weeks. So markets go up and down, and that, of course, stresses the importance of strategic asset allocation. We began Petra as the archetype with a moderate growth portfolio strategic asset allocation, not an aggressive growth portfolio because of that, because she needs to have some amount of money that is more immune to volatility, and she wants to have both impact and growth in the rest. So hopefully with appropriate strategic asset allocations, investors who consider themselves to be long-term investors will be able to ride out individual storms, even if with respect to private markets, those are kind of longer-term storms rather than in the public markets. So maybe not a complete answer, but I hope Anne responsive to some degree.
Can we have one over here? Oh, maybe not. I see one.
Edmund, before you run to the airport.
Definitely, that's why I take this opportunity. Well, thanks for sharing all of this, really insightful. I think I have two questions. One is there a crossing to age categories? So is there a different approach according, well, dependent on age level? And the other is we have return expectations, but do you also have actual returns realized?
So we don't know the answer. We didn't segregate the portfolios by age, did we?
That's not analysis that we did for this one. Yeah.
Yeah.
We had to draw the line somewhere, Edmund. We didn't want to be here another hour. But yeah, we'd have that information, and that could be for future analysis. That could be a deep dive that we do. That'd be interesting.
And I think one thing that makes that challenging is what age is a family office portfolio for? It's for, so for the individual portfolios, that makes more sense than for some of the other ones, but I think it's an interesting question.
We also do collect data on how long they've been in fact investing as well. So that could be another angle that we explore as well. So not just their age, but how long have they been doing this?
So the second question about actual returns rather than anticipated returns, you are not the first person to ask. We all wish that we had that data. It's incredibly hard to collect. We are not getting fees, unlike an advisor, right, who might have a feed of brokerage accounts or a platform in which all of the private investments live, and you can calculate multiple uninvested capital, you can calculate IRR, with or without taking into account the timing of cash flows, all of those sorts of things. We're relying on self-reporting from people, and so we just don't have access to the actual return expectation, the actual return results. It would be very interesting. If you said, I'm going to bet that they're lower than what people anticipated, I'm not going to argue with you, at least based on my own personal investing experience as a whole, although of course some things have outperformed. But it's incredibly difficult data for us to collect, and we wish we could.
Should we take maybe the two more
Lana,
and then
right?
we'll
Yep.
land the plane?
Ilana Fogelman. I have more of a suggestion than a
Lovely.
question, which is in your slide of timeline, your choices of timelines were greater than 5 years, less than 5 years, less than 1 year. So basically, somebody who invested 1 year in 1 day was merged in the graph with somebody who invested 4 years and 11 months. From an investor point of view, those are a very wide range of timelines that differ. I'd be more comfortable with an investment of 1 year and 1 day than 4.5 years or something. So
Yeah, there actually is that. If I may not be able to quickly find the slide. Is it up, Melody? Can you help me? Up? There. So have a look. It's actually, the bottom row is basically cash, less than 30 days. This is less than 90 days. This is less than 1 year. This is less than 5 years, and this is greater than 5 years.
but between 1 and 5, what about 2 years, 3, 4? Those are,
There's not a whole lot of investments that have 2-year or 3-year or 4-year liquidity. It tends to be either privates that have longer lockups, like if it's in a fund, it would tend to be If it's in a fund, it would tend to be 10 years plus. If it's a private direct investment in equity, you have no idea what the liquidity is going to be. Debt there might be some debt that would be in that range where disaggregation would help. But I take your point that that a little more granularity there might be helpful.
And quickly, with regard to assets by geography, it caught my attention since I'm Brazilian, that Latin America invests mostly elsewhere. But I was wondering what classes of assets are available there that make them, so that would be another interesting analysis to look at types of assets by geography.
Yeah, super. Mouse.
Yes, Michael Brown, Head of Research at the Wharton ESG Initiative. I might be the only other researcher in the audience.
You are,
here,
and one of the members,
So-
part of the Academic Research Consortium. Thank you for being here, Michael.
So I'm excited by the bar graphs and the pie charts and everything.
Yeah.
But I had more of a meta question. Sort of, the first finding was, I think it was worded they're increasingly interested in investor contribution. And I'm wondering, was there any data on that increase in interest over time?
Want to handle that here?
So I might have just missed it, but that strikes me as a really important theme right now in discourse on impact investing. Yeah, so go ahead.
Yeah, definitely. So we have collected data 3 times over the 10 years. And we did end up changing the names a bit, but so it's been both an interest in contribution in that we see more allocations towards contribute to solutions and that investments of that type, but then also more formal ways to measure the investor contribution on that side. We didn't collect that early days because we didn't even have the language and vocabulary for that. No. So we now have that structure, and that is another data point that maybe in the future, if we ever do another data collection, it would be great to mark that point as well. But again, we have kind of the actual just extrapolations from that portfolio, investment data, and that way we can take that to mean that there's more contribution.
To the slide that has enterprise. Don't we have a slide that has enterprise impact by over time?
Yes.
See if this answers. Thank you. See if this answers your question.
Particularly interested in investor contribution, but also.
Oh yeah, we didn't have investor contribution going back in time.
Yeah, we haven't been able to collect the investor contribution yet over time. But we can also, I will say one of the things that colored our research a bit is not only the hard data, but conversations that we have with the contributors and conversations we have as the Toniic community. So we have that benefit of kind of this long-term relationship with the people that we're collecting data from, as well as that hard data.
Wonderful. Thanks a lot.
Other questions? I have 2 microphones.
So many microphones.
Yeah, all right. Can you help me?
All right. We started on time and we ended late. I apologize. But I do want to thank you all for coming. I will get us through and look at all of the things we covered today. I'm so proud of us. I do want to get us to, we have some refreshments out when you guys entered at the top of the stairs there. And also just want to mention that I want to give Dara a little bit of time to wrap up. Nope. Adam's going to wrap up.
Adam's going to wrap up, right. So thank you all. Please help us to share this report far and wide. We're already at work on the next one, which we're doing with Impact Frontiers, which is a joint project that'll go deeper. It will not answer every question that you can imagine because we're building on the data that we have, but it'll go deeper into investor archetypes and strategies, which we expect to release later this year. And I know I did see nods in the room when we talk about how does it differ for a family office versus an HNI? And there is quite a bit of data like that in the report now, but we'll go even deeper in that on the upcoming one. So most of you in this field are already active in the impact and investing, systemic investing field, which means you are already convinced. And we appreciate what you contribute every day. And we want to invite you to help us continue to activate the impact curious to get started on their journeys. One of the best ways to do that, as Peter well set me up for is for them to join a membership organization like Toniic or like some of the other networks that I see represented in the audience. But please, whatever group they join, encourage private investors to get started. And in this approach, it's never been easier. It's never been more urgent. And it's also never been clearer the role that private capital must play to improve outcomes in the midst of a dramatically shifting world order. So with that, we thank you, and we will all mingle outside, meet some new folks. And thanks for your attention. Please help us share the report.